Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the real reason mortgage rates are headed higher. And spoiler, it may or may not have to do with the election. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah. We've had so many questions in the last few days that I think this is going to be one of the more important podcasts we do because of the increase in bond yields and mortgage rates. So we're going to have to give the people what they want.
Yes, we will. Okay, so let's dive in. Where are we with the 10-year yield and mortgage rates? I know it's disappointing to anybody in housing.
Okay, so what's our premise always? The 10-year yield is doing what with mortgage rates?
It's doing a slow dance.
It's doing a slow dance. By the way, Miss Santiago, New Jersey, what we want is we want the slow dance to be a little bit more intimate. We want the spreads to get better. And then when the 10-year yield goes down, we'll start to have better mortgage rates. So, ooh, da-doo-doo, da-doo, the very first time that I saw your brown eyes. That's the kind of mortgage rate atmosphere we want because the slow dance becomes better. Now, what's happened in the last few days is not only has the 10-year yield increased, but the spreads have gotten slightly worse from the recent lows. So that just puts another impact into rates moving a little bit higher. I would equate it to about 18 to 23 basis points. So almost 0.25% higher in rates than what we would have been, let's say, before the Fed rate cut in terms of how the spreads are. So you put those all together, we're almost back up to 7%. What does this remind us of? 2023.
Yep, last year, this time.
2023. Actually, no, this is early 2023 we're talking about. So back in 2023, the 10-year yield was going lower. And I'm saying this because a lot of people are being a little bit too aggressive on the economic calls in the cycle. So back then, mortgage rates were falling, the 10-year yield's falling. What did we do? We created the Gandalf line. Right? We said, okay, at 3.37, it really shouldn't go any lower than this because that's like recessionary. And what happened? 8 different times we kept on testing that. So we created the Gandalf, you shall not pass, because we didn't think, well, I didn't believe the US was going into recession. So what happened? 10-year yield shot right back up higher. Here, a repeat, not Gandalf, but Hodor, right? So the Hodor line is created at 380 for all of you in the mortgage and real estate industry, that if we break under 380, which it took 3 of the 4 negative job reports that week, two reports ago, for it to get there, and we got to such a low level that it required economic data to get worse. That's why the Hodor line was created. And I encourage everyone, because I think a lot of people are listening to people who do not track economic cycle work, not housing, but economic cycle work. There is an index. I showed you it this morning, right, Sarah, the City Surprise Economic Index and then the 10-year yield. They are dancing with each other, very apart from each other, but they are running in line. When we got below 380, all of a sudden, there is a ton of economic data since the day the Fed cut rates that beat expectation, which means you have a very, very high bar of needing economic data to get weaker, not beat to the upside. So the economic surprise index went up and then the 10-year yield went up. I encourage everyone to go to my Instagram page because I think visually you all need to see this. It has been a fluid, perfect motion right there. Now, when the 10-year yield was at 470 and we're heading down to 380, everybody was talking about, oh, the labor data is getting weaker, the revisions, job loss, reset, here it comes. A lot of those things were true, but we got to a point to where if it didn't get worse, bond yields went up. Now, from 380 to 4.25, nothing too dramatic on that side. If the economic data is getting better, bond yields go up, economic surprise index go up, GDP is running at 3%, retail sales, it's not shocking, but you have to realize there are key levels in the bond market with mortgage rates that will require weaker economic data. And when that doesn't happen, bond yields go up, economic data starts to improve. We have a series of economic data that beat estimates. That could explain a lot of this. But then what happened last week, and I don't like talking about political economic theory, but one of the more conservative Wall Street people that a lot of people follow, Druckenmiller, started to say that you really need to short the 10-year yield, because if Trump's winning and Trump does win, bond yields shall go up higher, and the Fed's going to have to be more restrictive because of tariffs. Whether you believe in that premise or not, that is something that some people are pushing. Another Wall Street person said, hey,
and
listen,
how does that affect, and how does that affect, because some people are doing that, so they're taking that action, and that is pushing rates?
Well, there's a lot of bets that bond yields will go up higher and mortgage rates will go higher, right? And typically when rates go up higher, economic growth goes with it. Some people say that there will be more inflation pressures because of tariffs. Whether you believe in that or not, that's irrelevant. I'm trying to get people to focus on the economic data has got better recently. Remember, Wall Street talks their books. So if you have conservative Wall Street people saying that the Fed's going to have to be more restrictive because of tariffs or whatever, just leave that alone for a second. I know it got a lot of headlines, but it does somewhat explain Monday's action. Monday, the 10-year yield was at 410. It was a little technical level that needs to be, as soon as it broke, it went up higher. Yields have gone up aggressively here. We've seen periods of times in the last few years where yields go up and down aggressively. Okay, so don't put too much on the Trump tariff thing. And now I'm going to give to you why I'm not a big believer of that anytime soon. I don't play the political party. If I had to play the person, right? And people say, and there's a lot of conservatives who say this is inflationary, this will be bad for the economy. President Trump talks a lot. But let's go back to 2016. In 2016, he had a better backdrop to start the trade war tap dance. He neglected to do that until rates went lower and they got the corporate tax cuts in. It facilitated a better environment to do this back and forth trade tariff war with countries, especially China. What occurred in 2018 and 19 is that business investment in the US stopped. The markets were very volatile, and it didn't quite work out as planned. And then they started to fix the trade war. They signed some deals, and then all of a sudden, the economic data started to get better toward the end of 2020. It got good into the first 2 months of 2020 before COVID happened. So this is just me talking. If President Trump wins, don't go into it's going to be inflationary, trade wars, all this stuff. You're going to have to wait until the actions occurs. And I don't believe, knowing him, that considering how the stock market is done and how the economy has been growing, that they want to go into that right away. They're probably going to need rates to go lower. Trump wants rates to go lower. Why? Because he wants the dollar to go down so you can export more stuff. So I won't put all the eggs into that basket right away, because I don't think that's his MO, right? He knows what's going to happen if he goes straight into that in this environment. So I don't put much weight into that. But for now, there's a lot of conservative Wall Street people saying this. Okay, so you're going to see a lot of headlines on it. My argument here is that I encourage all of you, go to my Instagram page, look at that. Economic surprise index picked up, bond yields have picked up. We're at, I think this last time I looked, we're at 4.22%. There's nothing shocking about that. In the mid 1990s, the 10-year yield was between 6.7 and 5.25, right? When we had good growth back then and inflation wasn't that much different than what it is now. The only time the 10-year yield went below was August and September of 1998. We had total market stress then. So let's put more weight on the data first and not what could possibly happen in the elections or anything. But for this week, it can explain some of the aggressive moves on bond yields starting from Monday out there. And on a technical basis, 4.36 to 4.40. The upper range, I know this is too geeky for a lot of people. The 10-year yield going down from 5% all the way down. If I take the upper end range, that 440 level is key. Until we break that level higher, let's just keep everything with the downtrend and stay in line with the economic data. If the economic data gets worse, bond yields will go worse. If it gets better, bond yields have the potential to go up. But let's keep an eye on that 440 level for now if we test that level. We're not there yet, but hopefully that tries to make sense because a lot of people are confused. Consumers are confused because they see mortgage, the Fed's cut rates aggressively. The labor data is getting softer and rates go up to 7% very quickly or heading there. Same thing happened in 2023. Gandalf, Hodor, two guys with white hair.
Okay, but so I'm glad you're addressing this because you have been addressing the economic factors that influence this. And then this is one of those variables that we've brought in at different times when sort of outside forces. If you're in real estate, if you're in lending out there and you have people in the pipeline. So my son right now, he's trying to buy a house and he's like, Mom, should I wait? Is the election going to affect mortgage rates this close? We're less than 2 weeks away from the election, and you have realtors, you have loan officers, and there are people who are like, should I just hold? Will it go down or will it go up? I mean, what do you say to that?
Economic data matters more. If jobless claims had been spiking higher, we won't be having this discussion with higher yields. We've always said jobless claims data matters more than everything else. And what has happened, that has improved recently. So what do you need for jobless claims to get worse? Well, the one sector, or actually there's a few sectors now, because the cost of capital is now too high, there's a lot of companies now bringing back production. Okay. Housing starts is one of them, right? Permits are at recession lows. Single family permits on the verge of falling again. That in itself, if it filtrates into the labor data, will rise jobless claims up, mortgage rates go down. If you're trying to time yourself on an election, good luck on that. All I could tell you is that we created that 380 level for this year and said, December of 2023, said we got here. I don't think it should go any lower than this. It didn't. Here again, it got 380. I said, boy, we really do need weaker economic data. It didn't happen. And bond yields have gone up. The economic index surprise have gone up. So you have to track this data. If you're trying to play a presidential race, honestly, good luck for all you guys. If you really cared about this stuff, you got to follow people that track data weekly that can maybe explain this to you. This is why on HousingWire's YouTube page, we have these short videos every single day. We talk about this on the Instagram page. We try to teach this on what economic data matters more. But this was one of these sharp moves, and there's a lot of talk from conservatives that Trump's tariff thing will be inflationary and the Fed will have to be more aggressive. I put nothing into that at all, because to me, the economic data still matters more. And that makes sense to what we saw from that low level, because that's what we've talked about. We focus. We don't create these levels just out of thin air. We create them in relationship to the Fed funds rate, economic expectations, where everything is going.
So give me a couple of scenarios. So when does the next jobs report come out in relation to the election? Is it the
next week?
It would before? Okay, so next week, the week before the election, we will have the jobless claims data.
Well, tomorrow, when this podcast comes out, you'll have the jobless claims data. But listen, jobless claims isn't just going to spike up vertically, okay? We need certain sectors to start losing jobs a little bit more participating. Now, we saw manufacturing data start to lose some jobs the last two reports. Residential construction jobs really are the key to economic cycles. And it had been growing a little bit just because rates have fallen. Now rates are going to go up. There's nothing that's going to change anything over the next 2 weeks, okay? But if you're talking about a short term, next week is jobs week. If the data becomes weaker, let's say jobs missed and we have negative revisions, bond yields go down.
And that's Friday. That's next Friday is when we get that data.
Yeah. But it's jobs week. So the job openings data, the jobless claims, ADP report. So it's the whole week. Two months ago, we had 3 of the 4 labor data was negative revisions. Everybody was talking, we're going to a recession and The 10-year yield broke under 380. That was the hoarder line. It took 3 or 4 reports to break down there. Then we had a series of data lines that got better. There it is. And that's why I think if people visually see this, because I'm going to be honest with you, the bond market doesn't care what I think, doesn't care what you think, doesn't care about you venting on any Instagram page or anything like that. If the series of economic data gets better or worse, that's where bond yields are going. So if you really want to, you just got to track this stuff out. I just don't think a lot of people tracks this stuff. Normal people have lives. So follow people that actually are not ideological bias or maybe not so tied into the mortgage or real estate industry. Because I realize this sector has been in a recession since June 16th, 2022. Everyone wants some kind of lower rates. Like purchase application data came out today, down 5% week to week. We see positive housing data when rates get to 6%. Trust me, it frustrates me more than anything, right? Because I don't think it makes a big deal if rates get down to that level. But you where we are right now in the economic cycle, where Fed policy is, and you got to remember, why does the Fed keep on saying they're restrictive? The Fed's funds rate, the growth rate of inflation, they want this to eventually come down to this. This was their whole 2022 premise. We want the Fed funds rate to match 3, 6, 12-month PC. Well, that means you're cutting rates a few more times. That's just neutral. But if the labor data breaks, breaking and softening are two different things.
Right.
10-year yield goes lower without the Fed. Doesn't matter what the Fed does. We just aren't there yet. And we got to a level because everybody keeps on telling me, well, the data is fake. The data. Nobody cares what you think. The bond market is just going to override you in a second. You could sit there and listen to people that say all the data is fake, everything's nobody cares that's trading the marketplace. They see retail sales beating estimates. They see GDP running at 3%. They're like, okay, we're not taking this any lower. So I encourage everyone, you got to listen to people that do not have an ideological or financial incentives here. I love to see housing come back, but I am bounded by the laws of data, right? I don't really care. I can't go against that. And that's why we created the hoarder line at 380 to try to explain that.
So next week we have jobs week and we'll be getting data all week long. That's going to affect rates. The next week on the election, you can say that, that's not going to, that is very hard to predict. But I think that the week of the election is going to be very volatile in rates one way or the other. What I think what you're saying is you can't predict it, but it will definitely, that week for those days will definitely have an impact.
So volatility short term is one thing, sustainable trend moves are another. Okay, right. So that's just a difference. We would not be having this conversation today if retail sales missed estimates, if GDP was running below trend, and the labor data got worse. We won't. That's why that chart I showed you this morning, Sarah, it's like, oh my God, there is a lovely relationship here for a reason. Okay, so we'll see how the jobs week turns out. Again, if you have a miss on jobs report and then it's negative revisions, bond yields go lower. That's right before the election, right? People say, well, Fed President Bostic says, it seems like there's some holding up on business investment and consumer purchases due to the election. Guys, when rates were going lower for the last few months, purchase application data was rising. It was the best 18 weeks of the year heading into the election. Rates went up. Oh my God, the demand fell. Try not to take other shiny objects. Focus on the bread and butter. That has always worked since the Peloponnesian War.
Well, yes, but and I totally hear what you're saying about long term and the trend. But when you're in the trenches on those days, it's going to be crazy. I mean, I think it's going to be crazy.
And that's why if you'd followed the economic data, things changed. And that's why we created I say this over and over again. I did not create the hoarder line out of thin air. It's now twice now at the end of December and here. We need to see weaker data and it didn't happen. So whatever happens during the run up of the projection, that's a few days. Okay. But I'm just trying to caution people on if Trump wins, there's going to be tariffs and inflation. It's bad for the economy. That's not his MO in the last presidential period. He waited to a certain time. I encourage everybody, go back, look at it, right? The 10-year yield did rise when Trump won. Economic growth, tax cuts, things will get better, but it's also working from a very low level at that period. Now you're going to see a lot of volatility. The bond market can be crazy in the short term, but it's still bounded by the range. So even if Trump had won and the economic data starts to get worse, bond yields will go down, even with the people that say, no, the 10-year yield has to go up. And in the big picture, the economic data matters more.
Is there a correlating thing that people are looking to if it's a Harris win? Do they think, oh, we get a bounce or it goes down, or like what's the
counter is to that? If the 10-year yield goes lower, it's predicting Harris is going to win. I mean, there's a lot of marketing betting things that are going on. I don't care or pay attention to that. The only reason I'm bringing this up right now is because some of the more conservative Wall Street types are talking about higher rates and the Fed being more aggressive on tariffs. I'm imploring you, everyone, to kind of ignore that until whoever wins the election will go from there. Short term, of course, volatility. We saw that when Trump won the first time. But you're going to need, for it to stick, you're going to need certain things to happen. Let's wait until we get to that area out here, because I think a lot of people are missing the picture that a series of economic data just got better. And I implore everyone, go look at that city index, go look at the 10-year yield. It is priceless. It moves together for a reason, right? As economic data was missing and we're getting weaker stuff, 10-year yield fell, economic surprise index fell, and then all of a sudden it changed, right? So this is why key technical levels matter.
This time last year, we went towards 8% mortgage rates, right? I think it was October 19th, something like that, last year. So remind us of your forecast for rates, not just 10-year yield, but rates for this year. And also where you think that could go. So say in the next 2 weeks when we have those short-term drops or gains or whatever, do we still stay, given all of those things that could happen, do we still stay within that range?
So the range for mortgage rates, 7.25 to 5.75. That's where it is. Now the spreads got better a little bit earlier than I thought. So mortgage rates, even with the 10-year yield getting to, above 4.25, weren't fully pricing in bad spreads. So rates have acted better this year because the spreads have gotten better. So we've been in this 5.75, 7.25 range for most of the year. That's why I talk about ranges, and then we work off of the economic data. This is why we track weekly stuff to give everybody an idea. So we don't do I'm going to forecast a mortgage rate. I'm not going to talk to any of you for 3 months. 3 months later, I'll forecast. No, there's no good there. We track we do this. I mean, literally, I'm waking up at 1 a.m. and doing 10-year yield overnight trading charts, so we don't want to not hold your hand. We want to hold hands together on this every single week. So right now, the most important thing, there's going to be volatility for the election, but that jobs week is really important. If something changes, positive or negative, that's what's really going to drive this. But we have a point to where Fed policy is trying to get down to neutral. And remember, just getting down to neutral means it's not being accommodative or it's not going to be restrictive. We're still far away from the Fed funds rate getting to neutral, but we got to a level to where it was really pricing in everything and weakness in the data, and that turned. And that's what I'm trying to get people to focus on, because it's a shock, right? Everything is going to 6%, everything, and all of a sudden it was a quick reversal. And I think people get into this. The economy is strong. Let me give you guys a bit of advice. Don't think of the economy debate as strong or good. It's kids play. Anybody could interpret anything. Think of the economy either in expansion or recession. If you think of it in that way, it takes all the personal ideological things out of the equation. I want to take the human element. Humans are not efficient, right? Numbers are. Right? So you take the human element, because I'm seeing this on all of videos and everything. Everybody's like, all these people have been wrong, because what they were talking about is a recession. The recession isn't here, and the 10-year-olds got up and mortgage rates got up and they're surprised about it. And then they go, the data's fake. If you want to follow that, That's fine. It doesn't do you any good here, right? Recessionary data, yields go down. Expansionary data, when yields were that low, meant yields had to go up. The labor data has been getting softer for 12 months, right? But it's not breaking. And that's why we always focus on jobless claims data. Because when jobless claims data break, there's no going back. Every single economic cycle post-World War II, when that data line breaks, cycle's over, right? And then we get into another stage. We're not quite there yet. And this has been here for, God, since 2022, right? We've been dealing with this. And if the GDP estimates are 3% in Q3, it's really hard to tell people that the economy's breaking. Retail sales just beat estimates a few times. It's just, I get it. There's frustration, trust me, but keep the ideological ways out when you're looking at data, and then you become more efficient. And that's what matters, because that's all that drives this stuff, right? It doesn't matter what you and I think. Bond market doesn't care. It is simply going to go with that.
Logan, thank you so much. I appreciate it. I'm always pushing you. I always want you to tell me more about exactly what it's going to go to, but I appreciate you giving us that framework of what happened, why it happened, and what we can look forward to. And you and I will be on high alert for the next 2 weeks, as per usual.
It's going to be volatile, right? That's not anything big, but I always say, let the data run you first, right? Don't put your human ideological, nobody cares. Trust me, in your minds, you might think you are the most important person in the world. Nobody cares. The bond market doesn't care. It's just money flow, and money flows off of data and expectations. And what happened was the data got better. Nobody believed it. And the 10-year yield shot up. You just got to go with it. And this is why we track every single economic data possible out there to try to give an edge on where things are going. And jobless claims run at everything.
Yep, we do that every Saturday. The housing market tracker is on site, so people can
One last thing. Oh, I forgot one last thing. Existing home sales came out today. Sales still a tad under 4 million. Median home price is up 3% year over year. Whew. So for 2 years, I've been trying to teach all of you, you have to be careful of listening to housing price crash people. Right? They are simply not trained intellectually or data-wise to talk about housing at a core. And now that we're here in October with home sales slightly below 4 million, right? The supply and demand equilibrium matters. Doom porn is great for getting attention. It's not very efficient because we're almost in 2025. We were promised home price crashes in 2012, 13, 14, 15, 16, 17, 18, 19, 20. 2021, 2022, 2023, and in 2024.
And here we are.
These are not serious people, right? Follow people that have models and forecasts. Mike Simonson and myself, we have the best weekly data out there. We try to explain this to you. You're just going to have to trust the numbers, because you can't, with an honest mindset, think that those people were right.
All right. Well, thank you for bringing in existing home sales. Logan, thank you so much. And we'll talk again soon.
Pleasure.